Good afternoon, everybody, and welcome to Nedgroup Investments Budget Review for 2024. My name is Trevor Garvin, and I am from the multi-manager area of Nedgroup Investments. Today, we are going to be looking at the budget that was delivered in Parliament yesterday by the Finance Minister. And also, we know that the elections were also announced this week for May the 29th. So it was with much anticipation that we listened in to the budget speech yesterday. And there was much hype around, is the Finance Minister going to announce tax increases on a personal level? What's he going to be doing on the national health insurance? And many other potential areas where he was possibly looking to increase his revenue. The one new acronym certainly that I learned yesterday is GAFECRA, which is something that I think many people are now going to be reading about in the newspapers, and that stands for the Gold and Foreign Exchange Contingency Reserve Account, something that not many people had previously heard of, and certainly something that will be covered in today's presentation. So here to help explain the budget speech from yesterday, we have Nedbank's Chief Economist, Nicky Weimar, who has previously presented on the budget, and she has a great skill in really explaining lovely economic theory in a nice, simple and understandable manner. So we're really looking forward to Nicky's presentation and her unwrapping the budget. The agenda will be that Nicky will give a presentation now for approximately 30 minutes or so, and then we will have some time around about 20 minutes to have a bit of a question and answer debate on other interesting topics related to the budget. So Nicky, on behalf of Nedgroup Investments, thank you so much for making up the time to come and talk to us today. And we really await with interest your interesting interpretations and explanations on the budget. So with that, I hand over to Nedbank's Chief Economist, Nicky Weimar.
Good morning, everybody. I hope you're doing well. My aim today is really to give you guys, a quick wrap on where we stand with the budget, how we see it, how the Finance Minister is going to do what he aims to do, and hopefully some assessment at the end of the day as to whether we think, as far as fiscal policy is concerned in any way, whether South Africa is moving in the right direction or not. So let's start by setting the scene here. We're going to do it very quickly. Basically, South Africa is in a difficult position. We all know that last year was not a great year as far as economic growth was concerned. All of you know that. All of you can probably feel that in your bones at this point. And so we knew going into this budget, already from November's mini budget, that the South Africa's finances were in a very, very precarious position, and that this was going to be a difficult budget to put together. What made it even more difficult was, of course, that this is an election year. So it was going to be a balancing act one way or the other. Almost every budget for the since the pandemic has pretty much been a balancing act. And it's been made a lot worse by the fact that this economy is in a tough position. So this first graph here really shows you South Africa's GDP growth. I show you there in red the rand value of all goods and services produced in South Africa, so the absolute size of the economy, and there in green you see the year-on-year growth rate, so the official economic growth rate in that red line. And what is very clear from that is that we've been losing momentum. We all know that. By the time we got to the third quarter of last year, GDP shrunk by 0.2% quarter on quarter. If we take the performance over the entire first 3 quarters of last year, the economy grew by only 0.3%, and that is a loss of momentum from 1.9% in 2022. So we really, as an economy, as that red line shows, been just drifting sideways, just stagnating. And to make it worse, if you break it down, a lot of the weakness is coming from the production side of the economy, as we well know, because we were battered by really unprecedented, record-breaking load shedding during the course of last year. And as the year progressed, of course, we had the transport bottlenecks to deal with, which was the collapse in the rail network, and as well as the long delays at the ports and the processing of cargo. So the economy is drifting sideways. But if we break it down apart from the production side and we just look at the domestic demand side of the economy, which is what the second graph shows you, you can see that by the time we got to the third quarter, this economy was essentially only running off one cylinder, and that being government spending. So government spending really kept demand going. If you look at consumer spending, PCE on this graph, that started to dip second quarter and third quarter. In fact, contracted over both of those quarters, which is equivalent to a technical recession. So the consumer in a very tough place. Fixed investment activity initially staged a very strong recovery, started to run out of steam by the time we got to the third quarter. And then, of course, all that's really left then is government consumption expenditure. So government spending have been keeping demand going, but this is an economy in a very fragile position. And the big reason is, of course, load shedding. The most damage was inflicted by load shedding last year. No economy can grow when you've got 335 days of load shedding, over 6,900 hours without electricity, and spending the average of a year at stage 4 load shedding. It really is impossible to gain any kind of momentum. And that's been the reality. It's been an incredibly disruptive year last year. And that's just one element of the disruption business faced. They also had to deal with the crumbling rail networks and the issues at the ports. All of them have the same effect. All of these infrastructure constraints have the same effect on business. They tend to suppress your sales and your earnings, and they tend to drive up your operating costs, squeezing your profit margins, which obviously have implications for the amount the fiscus can take in terms of taxes. And you can also see that second graph I show you, Eskom's famous electricity availability factor. It's a sad fact that we need to know what the electricity availability factor is, but there you go, we do. And you can see despite all the interventions, despite the announcement of the Energy Action Plan back in 2018, despite the appointment of an electricity minister, your electricity availability factor at Eskom has just been consistently declining. And whatever relief we get in terms of load shedding appears to be more seasonal than actual structural improvements in Eskom's operational efficiency. So this problem is still with us. And then on top of that, squeezing company profits and therefore impacting tax revenue, we've also had a situation where global growth has slowed during the course of last year, and we all know what the story is there. We had a spell of surging or revival in inflation, which of course forced central banks the world over to hike interest rates, and that's been cooling demand, resulting in weaker and softer global growth. That is what we also experienced during the course of last year, and you can see how our exports volumes in that first graph just shows you the relationship between global industrial production by our big trading partners and exports, and you can see how they move together. And so export volumes have been declining, and a combination of all of these structural problems plus weaker global demand. And then top of that, they've been hit by a very significant correction in commodity prices. In the first half of the year, it was universal. We saw all commodity prices come down, especially our 4 big exports, which is gold, platinum, iron ore, and coal. And in the second half of the year, diverged a little bit. We saw gold and iron ore do a little bit better, but we saw that the pressure remained on platinum and coal. And all of these factors combined, weak economic growth, falling commodity prices, all the structural issues that drove up operating costs for companies and squeezed their earnings and undermined their profits, obviously meant that going into this budget, we knew that tax revenue was under pressure, especially corporate taxes. At the same time that we've had very significant hikes in domestic interest rates, 475 basis points since November 2021, and we know that even by the Reserve Bank's own account, that has now become restrictive, and we know that consumers are under pressure. As most banks will report, we have seen an increase in defaults on loans. And that's a reflection of the tough environment that consumers are in. So going into this year, the revenue side of the budget looked very fragile, and revenue was under pressure, but at the same time, of course, expenditure was still running ahead. And so we all anticipated that we would have an ugly budget. And already in the mini budget, the finance minister told us that our budget would not look good. And you can see this is South Africa's fiscal position over a longer period, going back to 1992. I show you there South Africa's budget deficit. And you can see we've been running budget deficits of over 3% of GDP consistently since 2008, 2009. You go over 3% of GDP with your budget deficit, and you are just simply adding to your debt burden at an unsustainable pace, and you're starting to run the risk of entering a debt trap, a situation where you've got to borrow money just to service the interest on your debt as a nation. You can see we've been doing this for a very long time. And last year in the mini budget, the finance minister told us, listen, it's going to be another horrible year. The budget deficit is going to probably be higher than they thought in February last year, and it was going to be around 4.9%. Many of us thought it might even be worse, given the pressure, especially on corporate taxes and the tax revenue they're getting from the mining sector. And then, of course, what does that all mean? It just means you've got this rapid build-up in your public debt burden, which is what that second graph shows you. And you can see our public debt burden climbed throughout the Zuma years, then exploded after the pandemic to much, much higher levels, completely unsustainable. A country like South Africa with a narrow tax base and low economic growth cannot sustain a debt burden of over 70% of GDP. And that is where we are. And the deficit of 4.9%, the finance minister told us in November last year, would result in a further rise in the debt burden. And what's the issue here? Well, the issue is essentially that debt service cost just starts to rise. And this next graph shows you exactly how dramatically debt service costs have climbed to much, much higher levels, and really rising from almost nothing. We were very, very good fiscal citizens going back to prior to 2009. It's risen all the way. Good day, everybody. Unfortunately, we've had load shedding here, which caused a disruption in our broadcast. We would like to think of it as you had an opportunity to go get some coffee. All right. So that's the way we'd like to think of it, and hopefully you did that. So I was in the process of explaining how the rise in the debt burden has pushed up debt service cost, where it's now up to 5% of GDP. And obviously what that means is that your debt service cost starts to absorb an even greater and greater portion of your tax revenue. And we've now reached that point where it is touching 20% of tax revenue, which just means you've got less and less available to spend on key economic priorities. So coming into this budget, already in November last year, the finance minister told us we're in a very difficult space. Our fiscal metrics would have deteriorated even further. And so we were all anticipating a pretty ugly picture. Then came the budget, and again, they have managed to pull a rabbit out of the hat. If we look at this year's budget, you can see that they have managed to end last year more or less at the estimates, well, almost exactly in terms of some metrics like the deficit, on the estimates they put forward in November last year. The budget deficit is going to be the ugly 4.9% of GDP, and the main strain or pressure there came from really revenue, which only grew by slightly over 1%, but that was better than they thought back in November, when they thought that revenue would only grow by 0.9%. So revenue lifted a little bit in the final months of the last fiscal year, or the current one we're in, that ends at the end of March. But you can see that expenditure continued to race ahead, and they continued to expend more than they budgeted for originally. So the bottom line is that's the situation we're in. But the good news is at least they stuck to that deficit they've set out for themselves. So now let's look at the years ahead. So we ended last year at the 4.9% budget deficit as a percentage of GDP, at your debt burden over 70% of GDP, at debt service cost rising quite dramatically. Now we're going to look forward and ask ourselves, well, what did they come up with for this fiscal year and for the next 3 fiscal years, which is, of course, their medium-term expenditure framework. Well, if we look at this fiscal year, like I said, they did manage to pull a rabbit out of the hat, and they have essentially come up with a much better fiscal picture than we would have anticipated. So the budget deficit stays over 4% in the short term, and that is not good. But the aim here is to bring the budget deficit down to 3.3% by the time we get to 26-27. And that gives you a sense of how surprising that is. Most analysts out there were expecting budget deficits of sticky around 5% for the next 2 years, and then maybe they dip it below 5% in the third year of the actual planning or forecasting period. And they didn't do that. They still seem determined to get this budget deficit closer to 3%, which is that sustainable key level. Now, how are they going to do that? That graph there shows you that the way they're going to do it is essentially they have put or penciled in much more aggressive growth in government revenue. That's what's going to make the difference to this budget. And they have kept continued expenditure restraint. So they stuck to the mini budget estimates for expenditure, kept that very modest. In fact, they're planning to increase expenditure by around 4.5% over the next 3 years, which is around about the rate of inflation. So in real terms, you're actually talking about expenditure cuts. And then after that, the biggest difference was, of course, made by the fact that they now expect much more aggressive growth in government revenue. Now, how are they going to achieve that? So let's first look at revenue now. The first point as far as revenue is concerned to make is that they're going to achieve it through the expectation that you're going to have a slightly better economic growth rate. That's the first point. You can see this shows you National Treasury's growth going forward, their GDP forecast, and they're looking for 0.6% in the year that's passed. That's all behind us now. We know that was a horrible year. But then they expect the economy to gradually improve, rising above 1% and grow at an average of about 1.5% over the next 3 years. Those are not wildly unrealistic estimates either. So that is the consensus out there in the market. That second slide shows you Nedbank's GDP forecast, in other words, ours, and also the Reserve Banks. We're a little bit more on the negative side than National Treasury, but it isn't wildly unrealistic numbers they've put out for the next 3 years. Where's that recovery going to come from? Well, they're banking on a lot of it coming from the world economy turning the corner, commodity prices starting to pick up, there being greater demand for our exports, and they're also banking on a consumer recovery coming through as South Africa gets inflation under control, and in the second half of the year, hopefully, the Reserve Bank starts to cut interest rates. So that's where they see that recovery coming through, and really, that is a common theme in the market as well there. Those are very similar numbers to most private sector economists. So that should help government revenue a little bit. The second thing that they're banking on is absolutely no tax relief. So that makes life easy. So this year you can see they're going to get about 15 billion in additional taxes that they're going to extract from the economy. The good news here is that they haven't increased any personal income tax rates or any company tax rates, but what they are doing is they're allowing inflation to do the job for them. They haven't made any adjustments to your income tax brackets, and in other words, they're allowing bracket creep to really do the job for them. And because they've not adjusted any of the brackets for the effects of inflation, what it means is as your income rises, you bump up into a higher tax bracket, and in the process you pay higher tax. So that's how they are going to get the money they need, by providing no tax relief. And it's interesting that they've pretty much penciled that in for the next 3 years, suggesting that they're not going to make any adjustments to those brackets for the next 3 years. So your tax incidence is going to increase. You are going to be paying more in taxes over the next 3 years. As for companies, also no major adjustments, and then they're going to raise more revenue from really sin taxes, which they are going to increase at a rate slightly above the rate of inflation. There you can now see the schedule for sin taxes. And the extent to which they're going to increase it, no big surprise there. And if you look at that breakdown, you'll see that they're punishing, for example, wine and beer drinkers more than certain other alcohol drinkers, but that's fine. And equally with tobacco and smoking, we're also seeing in some categories almost 8% increases in sin taxes. So there they're going to get a chunk of money. They didn't increase the fuel levy, and that might have been driven really by political motivations. And so they didn't make any changes there. The carbon tax levy, the carbon tax rate does increase, but only very, very gradually. And that comes through during the course of this year and next year. But everything else they left unchanged. So no changes to the rates. They are letting inflation do the job for them, and that's going to bring in more taxes. So the big trick about this budget is really on the tax front, and that should be doable, right? That should be doable. And even if government manages to get tax revenue to grow by over 6% over the next 3 years, that provides them with exactly what they've budgeted for here. The trick now is not to allow expenditure to also accelerate at the same time. And so that's really what this budget's going to be about, because the targets they set themselves on the expenditure front is very tight. They don't want to grow overall expenditure or consolidated government expenditure by much more than 4% over the next 3 years. Remember, debt service cost is a given. Because you've been running budget deficits of over 3% of GDP for over a decade, your debt burden has climbed, you have to service your debt. So that's going to grow at the rate it's going to grow. The best you can do there is try and cut your deficit, reduce your fiscal risk, and maybe that feeds into a lower interest rate, which help to control your debt service cost in the years ahead. So that's a key problem that they unfortunately will have to bear in mind, and it's going to require a tremendous amount of discipline. So because they can't do much about debt service cost, they have to focus on non-interest expenditure. And this they want to contain to an increase on average over the next 3 years of only 4.1%. That is less than the rate of inflation, than their own projections for the rate of inflation. So in essence, they are cutting non-interest expenditure. That is going to be a very big challenge. Debt service costs are still going to hurt, though. It's still going to climb. They're hoping to stabilize it at around 5.2% of GDP and then bring it down. And it is, if they succeed in doing that, they should cap the amount of tax revenue debt service cost absorbs or consumes at around 20%, which is still unbelievably high, unsustainably high, but at least if they can stabilize that, that is a good start. So that's the aim on debt service cost. The other big trick will, of course, be the public sector wage bill. Here they've put through estimates slightly higher than in November, which I think is more realistic, but they're aiming to grow the public sector wage bill with no more than 4.5% over the next 3 years on average. They're implementing the 2-year wage deal that was agreed this year, and thereafter they're assuming that public sector wages will increase with the rate of inflation. So in real terms, they will stay the same, their income will stay the same, but it will be stagnant. I think they're being a little bit unrealistic here. I think it's highly unlikely that public sector unions will accept such an outcome, but nonetheless, that is what they've budgeted for. So there is a little bit of I suppose, unrealistic assumptions coming through in some of these expenditure estimates. If we then look at how they're going to break it down, over the next year, The other spending categories, the fastest growth is in the smallest items. We know that education and social welfare and health are your biggest expenditure items in South Africa. The second one is obviously what are they going to grow of those items, all right? Essentially what they're going to be doing is that they are going to be growing policing and housing quite rapidly. And policing, I think, is absolutely valid, given that we've got a situation where crime has gotten a lot worse. That is now reflected in the way the world views us, in the sense that we got grey-listed by the Financial Action Task Force. So there's a lot of effort that has to be done on that front. And also businesses across industries, from construction all the way through to mining, are carrying the cost of high crime. It's become destructive and a disincentive to further investment and job creation. So that is essential. And then housing is a very small component of overall expenditure. That's going to grow in the year ahead, and there might be, again, some political motivations there. Going forward, the focus remains the same. You've still got policing and housing receiving the fastest growth. These are, of course, both of them fairly small items. And then they're just maintaining expenditure on education and social welfare, which are the two big ones. But on social welfare, there is a degree of, again, them not being entirely honest with themselves. They've been rolling over the social relief of distress grant. It's now again been extended for another year. And then they just stop it right there. They take it out of the numbers, right? We said when we introduced this grant, there is a very great risk that the moment you introduce it, you must pretty much accept that you can never take it away. And it seems to be that we are on that path, yet it's not put into the budget over the 3-year period. It's put into the budget for the year ahead, but not over the 3-year period. So no decision was made on that, and that makes the numbers obviously look a little bit better than it otherwise would have if you budgeted for either the SRD grant or its replacement, the so-called basic income grant, over the next 3 years. So no decision made on that whatsoever. And that's the expenditure story. And then the final bit goes back to what Trevor was saying, is the other way that they've helped themselves out is they have gone to South Africa's gold and foreign exchange reserve account, which is where you really see the benefits of the gains they've made on gold and foreign exchange reserves based on changes in exchange rate valuations. And, of course, also in the gold price. And that account is managed by the Reserve Bank on behalf of National Treasury. And they are going into that account, which stands at 500 billion rand. And they're going to take 30% of it, 150 billion. And they are going to reduce the public sector borrowing requirement. In other words, if you take the deficit and you take all the other entities they have to borrow for, including Eskom, and that gives you your public sector borrowing requirement. What they're going to do now is they're going to take proceeds from this account for 100 billion off this year's public sector borrowing requirement, and then 25 billion and 25 billion over the 2 outer years of their planning period. And that therefore means that they reduce the public sector borrowing requirement quite dramatically. That also, of course, feeds back into debt service cost and helps to control and reduce the rate of growth and debt service cost. Right, so that's it. It's not a very good or exciting budget, not on the tax side and not on the expenditure side whatsoever. In our assessment, what is good about this budget is that they clearly still aim to bring that budget deficit down. There's clearly a recognition that we cannot allow the public debt burden to spiral out of control and for debt service costs to just gobble up all our tax revenue. So that part of it is good, that discipline that they're still signaling. But now the trick comes in actually implementing that discipline, which will require that for a change, you get expenditure to match your budgeted increase, which is going to require a tremendous amount of discipline and might be very difficult. In terms of digging into the gold and foreign exchange reserve account, listen, it's helped, and perhaps there was no other way out at this point in time, but it is a short-term solution. And it is a little bit scary because it cannot become the go-to way of solving a problem. If fiscally you are in an unsustainable place, if you live beyond your means as an economy, if you spend more than you get in tax revenue, because of whether it be weak growth or poor fiscal discipline, then what you should fix is the weak economic growth and the poor fiscal discipline. And you should have a plan to do that. You shouldn't just say, okay, I'll go to this account and that's going to help me through and help me look a little bit better. I think maybe it was necessary just to break that hit and that ridiculous run-up in the public debt burden and in debt service costs a bit, but it cannot become the go-to solution for poor fiscal discipline in the years to come. Thanks.
Nicky, thanks for those great insights. And I think you really set the scene nicely for the next 15 or 20 minutes where we can have a little bit of a discussion on some of the topics that you raised. I think I'm going to just start on the one that you actually ended a little bit on, and that was touching on economic growth. You mentioned for 2023, they actually downgraded South Africa's economic growth to around 0.6, 0.8%. And for the next 3 years, we're averaging around about 1.5, 1.6% real economic growth. Now, if we think back to Mandela's time and Mbeki era, South Africa was achieving real economic growth of probably somewhere between the 3.5 to 4.5% amounts. And that amount we really saw then the economy growing and unemployment was materially lower than what it is today. I think we were sitting at around about 18% in those days. Now, this week, the unemployment figures came out there. It's gone up slightly from 31.9 to 32.1% unemployment currently in the country. So I just wanted to pick your brains on really, which I think is the key to success going forward, and that is our economy really needs to grow. And as you've mentioned, they are even forecasting growth of only around 1.5%. Now, is that really enough? And I feel that it's on the low end if we really need to get this economy out. And is that not where we're lacking? The government doesn't seem to be coming out with real policies to get us out of the 1.5% growth and get us to the 3 to 4% economic growth. Could you give your comments on that?
Yeah, you're absolutely 100% right. That is not nearly good enough to make any difference to South Africa and to South Africans, and especially it's barely enough to absorb new entrants into the labor market, never mind deal with the small army of unemployed and discouraged workers. So, you're 100% right. It is totally inadequate. It is also among the weakest growth rates in the sort of emerging market universe. So even among our peers, we are at the bottom of the pile. But we know what our problem is. We can't grow faster than 1.5%, so it is realistic. Because we have got these structural issues. So the first one is crime and corruption, which really started all these problems, hollowed out state-owned enterprises. If we think about state-owned enterprises, what do they provide? They provide critical economic infrastructure without which we cannot grow. And that's what we're now lacking. We haven't got enough electricity, we've got issues with crumbling rail network and rail services, and we have great inefficiencies at our ports. And those are just 3 big sort of themes, the ones we actually feel. We're now seeing also water shedding, difficulties with water infrastructure, so it just keeps rippling on and spreading and spreading and spreading. But right now, if we could just deal with crime and corruption, resolve the electricity crisis, and deal with the transport bottlenecks, we can probably add about 4 percentage points to our GDP growth. All right? That's how big a difference it would make. And so government and their number and saying we're going to grow by 1.5% admits that's not going to happen overnight. And all private sector economists have similar numbers. So they also admit That's not going to happen overnight. I think the key thing is, if we, at least over the next 3 years, where we're really going to struggle to grow much faster, if we can at least move towards gradually firmer ground, but then we need to use these 3 years to actually resolve those issues. That's the secret. We're not going to unlock faster growth now, but if we can use the next 3 years productively, we could maybe see that from 2028 onwards.
So, Nicky, yep, just on the one point there that you touched on and the state-owned enterprises, watching the finance minister yesterday after the budget, and he was being interviewed, and he actually made a good point, I think, that many people perhaps forget, is that historically, not only have we having to bail out the state-owned enterprises, but actually these state-owned enterprises are taxpayers like any other corporate. And when they are not running at a profit, they themselves are not paying taxes which come into the tax revenue base. So it's been a double negative up until now.
Absolutely.
One, they're not paying taxes, plus they needing to get these bailouts.
Well, it's actually a triple negative because they also hit the economy. So it's three things. That also reduces taxes.
Correct, exactly, by reducing the economic growth. So just, you did touch on it now, but can you just give your opinion on the next 3 years, I guess? And we've spoken a little bit about Eskom as one of the SOEs, but we know that there are many other ones. Do you feel the government is making progress on these SOEs, turning them around, and that they are actually going to start contributing to the tax revenue going forward?
Yeah, okay, I don't want to be mean to all the other SOEs, and there are many of them. We're now going to get a state bank and, you know, all of these other interesting and fascinating things. But there's only three really that matter, right? And that's Eskom, because they supply electricity. It's Transnet, because they deal with the rail and the port, logistical side of any business and any economy. And the next one is the water boards. They are absolutely essential. You can't operate without access to clean water, and many businesses can't operate without access to water because it's a part of their production process. So those three are absolutely essential. Now, in terms of water, they've got some projects on the go now. Hopefully that will be resolved, but clearly there is a disconnect between the water boards and then ultimately also the municipality that has to provide the water, right? So that's also a bit of a worry. And then the other two, which is Eskom and Transnet. The plans are afoot. You look at Eskom, it has now split into three. We have now got a transmission and distribution company. They are proceeding with legislation that will eventually allow more private generation to come on stream, and that companies can actually trade in electricity in the open market, so to speak, or over the counter. And any excess electricity they produce, they can sell onto the grid. But there are a lot of problems with plans, right? We are seeing that the private sector has certainly accelerated embedded generation, that the independent power producers are moving ahead quickly. Once a bid has been awarded, they go ahead and they get the project going, and they finish on time and on budget. They've been excellent as far as that's concerned, but our biggest problem is that we don't have sufficient grid capacity, right? So, and I know government said, well, for that reason, we acknowledge that's a problem. It slowed the process down. We're going to put 14,000 kilometers of additional grid capacity into the system. So that's what they've said. But let's be honest. Expanding the grid is a long, long process, right? Even in governments and countries where the government operates efficiently. You have to secure the land. You've got to go through the whole legal process to get the land, so you can run the power cables through there, put substations along the way. It's not a simple and easy process that you just flick your finger and it's there. So government believes that given the project currently in the pipeline, by the time we get to 2026, load shedding would either be greatly reduced or totally eliminated, all right? That's basically what you also see in the budget, where the finance minister gives us a sense of the amount of megawatts that is planned to come through this year, next year, and the year thereafter. But our view on that is it hasn't come through that quickly, and it's not likely to if you don't have sufficient grid capacity, and expanding the grid is a long process. So if government's saying 3 years to solve the problem, we would say it's probably closer to 5 years. And then in terms of the rail and the port issues, we haven't even begun. They will now invite, and in fact, Transnet has appointed a private company to run one of the terminals at Durban Port, but there are all sorts of other issues around that. That process haven't gained any traction yet, so I don't think that's anywhere near being resolved. So that's also going to be with us probably for longer than 5 years. And like I say, we're not going to get around that. That is going to limit our growth rate. So if we can just gradually crawl in the right direction, then I think we're doing the best we can given our existing constraints.
Nicky, just to take it one little step further, and we mentioned a little bit now, part of the government's forecasts for the next 3 years is some inflation assumptions where they're assuming inflation is going to go down. I think they're averaging inflation around 4.6%. They're assuming, as you've just mentioned now, electricity getting under control. Can we just touch on and get your thoughts on some of the geopolitical risks that could derail these? So, of course, we have certain conflicts going around in the world, which may affect energy prices unexpectedly, that could derail inflation coming down, not only in South Africa, but globally, which would then have a ripple-on effect to delaying interest rates, perhaps declining. These are all ifs, but if these things happen, could it derail some of these forecasts that they really have set out over the next 3 years? And where do you see the risks of things potentially going wrong on a global scale?
Okay, when it comes to forecast, there's always risk. Okay, nobody knows the future perfectly. I know it's part of my job to do the forecasting, but the reality is a lot can go wrong. So yes, there are risks. The geopolitical story is obviously based purely on what we know today. A lot of things could happen between now and the next 3 years that is not even on our horizon at the moment. But we know that we have got conflict in the Middle East. It is affecting, transportation routes. It is affecting spot freight rates, especially in terms of shipping costs. And that's mainly because it's spilled over into attacks on cargo passing through the Red Sea that has to go to the Suez Canal. So that can affect global shipping costs because a lot of that cargo is now being rerouted, and that can also therefore affect global inflation. By driving up input costs for companies again. Now, although it's increased, it's nothing near the disruption we experienced in 2022. So we're not even talking about that scale yet. But of course, the risk is there that can be a source of inflation, and it can keep inflation higher for longer, and therefore global interest rates higher for longer. So that could very definitely go wrong. The other key risk of course is that Russia is still in conflict with Ukraine. There is this sort of greatest sort of hardened rhetoric between NATO and Russia, which is, I suppose, not could also maybe trigger something, God forbid, that could also affect just general confidence, result in price movements. Also, any further sanctions against Russia could again put some pressure on commodity markets, especially the critical ones. But even there, it doesn't seem to be doing that at this point in time, and it isn't anywhere near the disruption we saw in 2022. So assuming that inflation comes down, to me, seems like a reasonable assumption. I think the biggest threat there is that the world economy actually proves more resilient than anyone's expecting. And so demand doesn't slow sufficiently to bring inflation in your rich countries all the way down to 2%. And therefore, interest rates either start to be, the easing in interest rates start much later. And when it starts, it's much more gradual than anyone anticipated. So I think that is a key risk that we need to bear in mind. And that's a very realistic one. And then the last geopolitical risk will, of course, be that the whole world's going for elections. And in this world in which we operate, where there is a lot of conflict and a lot of tension, it is, of course, important where South Africa aligns itself. We didn't do a good job of that in 2013. Our relationship with Russia put us in the spotlight. We attracted all sorts of unnecessary attention, scored a whole bunch of own goals, and really aggravated the value of the rand and also government's risk premium, and therefore the cost of capital to them. So it really, really has been a little bit self-destructive. Hopefully we'll be a little bit wiser in the years to come. But with all of this political turmoil, that could add an additional layer of uncertainty and disruption going forward, especially what the likely outcome will be of the US elections. That could change the forecast completely. So yes, there's a lot of risk. Right now, it seems realistic.
Yeah, potentially 4 more years of Donald Trump as president is going to be interesting. Nicky, the one other area I feel we need to just touch on is the national health insurance. There was quite a lot of talk, perhaps, before the budget speech that announcements were going to be made on that. He didn't really make too much noise about that or announce anything unexpected. I read an interesting article the other day comparing potentially South Africa's hopes or aims for the NHI versus the National Health Services in the UK, and they were comparing it because the two countries have a similar population size of around 60 million. And currently, we're spending about 285 billion on health. In the UK, they're spending 2 trillion rand, yet have many problems with doctors and long waiting sort of times for procedures, etc. Do you see the NHI initiative still going forward and progressing? Do you think it's going to be a gradual rollout over a number of periods? And obviously, can South Africa, and you've set the whole scene in terms of our current revenues versus expenditure, can we afford to implement something like this?
All right, so I think it's very clear we cannot afford it. It's the thing that everybody has always said from the moment this idea surfaced many years ago, in every conference, in every discussion, in every government brainstorming session they may have had with the private sector. It has always been clear that we can't afford it. To have sort of healthcare to the extent that they foresee on about 6 to 7 million taxpayers that actually fill in returns for 60 million? No, that's just impossible, all right? So we can't afford it, but clearly politically they're going to go ahead, all right? And so what it means is that they're going to be in this purgatory. You're basically going to never have quite enough money to implement it, always promising it, and maybe these promises will roll over for a period of 5, 6, 7 years, and they'll gradually sort of start to dedicate money towards that. If you get a more radical government over that period, they might bring in much more radical tax proposals in order to fund it. But right now, what National Treasury is clearly saying is admitting there isn't enough money for this. Definitely not in the current situation, where we're already running a deficit of over 3% of GDP, and we're trying to bring it back to 3% of GDP. So we don't have enough money for this. And what they're saying is that you need to improve certain structures, and I think that's fair. It's not in place. You can't just suddenly roll ahead with it.
Yeah. So you've given the perfect intro to our last question, given the time, Nicky, and that is, I think we need your opinions and views on the up-and-coming elections. The date was set for the 29th of May. It's 3 months or so away. Just, do you have any thoughts of not necessarily what the results are going to be, because again, although you are a forecaster, as you said,
not a
but
political
more perhaps
forecaster.
the economic implications that may arise depending on how the results play out. Just would be interested on your thoughts on that.
Yeah, listen, I mean, I have got no prediction. I am not a political analyst or forecaster, and I would be surprised if political analysts or forecasters or pollsters will get this one right. So I haven't got a clue where it's going to go, just prayers, basically. I can't forecast, I can just pray. What would be negative for South Africa? I think if the ANC were to lose its outright majority and they partnered with the EFF, you've all seen the EFF's manifesto, there is no space for a private sector there. There is no space for private capital there. That would be perceived very negatively. And then all of these assumptions we're talking about now, that would be out of the door. And the way that the rand would respond would, of course, be vicious, and that will have ripple effects for inflation, for interest rates, and at the end of the day, for economic growth and employment creation. So I just don't think that foreign investors that really drive the value of the rand will embrace that sort of coalition. If, however, the ANC loses its outright majority and they team up with a group of smaller parties, I think you'll have more of the same.
Yep, it's going to be interesting to see how it all plays out. Nicky, we are done with time, and I know you also have to rush off to other commitments. Thank you so much for joining us today and giving your insights and summarizing the budget of 2024 and the next 3 years. And yes, I think yourself, along with all of us, are going to keep much attention on how the next 3 years roll out, and certainly government's implementation and whether they can actually stick to their promises. So thank you very much for joining us today, and we appreciate your time. And to everybody else on the webinar, thank you so much for joining us. We had a great turnout. We hope that you found it really interesting. And yes, we look forward to the elections in May, and we certainly will bring you some analysis of that when we know the results. So thanks for joining us today, and may you have a good rest of the week. Thank you.